If you're over 40, you're probably overcomplicating your investing. Too many funds, too many apps, too much noise. And all that complexity might be quietly costing you money. Today, I'm going to show you the only 2 Vanguard ETFs many investors over 40 really need. Simple, proven, and built to work while you sleep. Here's the real problem. When you're 25, you can take huge risks and hope everything works out. But when you're over 40, you're not finished building wealth, yet you can't afford reckless mistakes either. What you need is a 2-engine portfolio. 1 engine for growth, 1 engine for income and stability. And Vanguard has built exactly that. Let's start with ETF number 1, VOO, the Vanguard S&P 500 ETF. This single fund gives you ownership in 500 of America's biggest companies: Apple, Microsoft, Nvidia, Amazon, Alphabet, all inside one simple ETF. Over the last decade, VOO has delivered exceptional returns. But what makes it especially powerful for investors over 40 is something most people overlook. It is self-cleaning. When a company weakens and falls out of the S&P 500, VOO automatically removes it and replaces it with a stronger company. You don't have to pick winners. You don't have to decide when to sell losers. The index handles that for you. That's powerful. And the annual fee? Just 0.03% annually. On a $100,000 portfolio, that's roughly $30 a year, less than many people spend on dinner. Now let's talk about ETF number 2, VYM, the Vanguard High Dividend Yield ETF. And honestly, this is the ETF many investors completely overlook, which might be a mistake. VYM owns hundreds of dividend-paying companies. Companies like JP Morgan Chase, Procter & Gamble, Walmart, Broadcom. These aren't speculative startups. These are established businesses that have survived recessions, pandemics, market crashes, and economic uncertainty. VYM currently provides meaningful dividend income while maintaining broad diversification. And here's why that matters when you're over 40. Dividends continue arriving even when markets are struggling. When everyone else is panicking, VYM investors are still receiving cash payments. That income creates confidence. It reduces the temptation to panic sell during bad markets. And the fee? Just 0.06% annually. Still incredibly low. Now, here's where things get interesting. Combine VOO and VYM together. Think of VOO as your offensive player, driving growth, building long-term wealth. Think of VYM as your defensive player, generating income, providing stability, helping you stay invested when markets get rough. Together, they complement each other beautifully. A simple starting allocation could be 70% VOO, 30% VYM. If you're closer to retirement and want more income, 50-50 could make more sense. Either way, both funds are diversified. Both are low cost. Both operate largely on autopilot. And that's the real secret. The best investment strategy isn't the most complicated one. It's the one you can stick with for years. VOO and VYM aren't exciting. They won't make you rich overnight. But for investors in their 40s and 50s, consistency plus time can create extraordinary results. And the good news is, time is still on your side. Use it wisely. Now I'm curious, which allocation would you choose? 70-30 or 50-50? Drop your answer in the comments below. And if you enjoy straightforward investing content that actually makes sense, subscribe. I'll see you in the next one.